Welcome to Quartz Smart Investing. I'm Merrill Brown. Our guest today is John Davi, founder, CEO, and Chief Investment Officer at Astoria Portfolio Advisors. John, thanks for joining us.
Good to be here.
John, it's a pretty good economy and a pretty negative market as we turn the corner into November. The S&P continues wobbling, but you're suggesting looking broadly at a portfolio strategy that reflects higher rates and a recession that may well be underway. How should the public assess the market?
Yeah, so I think that, 2 years ago, we made an argument that we live in a higher interest rate world, higher inflation world, things like deglobalization, onshoring, reshoring. So we just had this view, which is part of the reason why we worked with Access Investments to launch PPI, this inflation ETF. So here we are now, 2 years later, and that's kind of fully priced in. I think we, are on the border of having a recession pretty soon. If you look at the yield curve, it started to uninvert. So that historically has meant that a recession is very, very close. The irony of like inflation-linked assets is that they're very cheap on a relative basis. So the PE ratio of PPI is like 10 versus the S&P, which is at 17. So we just think now is a good time to kind of enter into inflation-linked assets and build your portfolio for the years to come when we live in this like higher rate, higher interest rate world, higher inflation world.
So the bet on a PPI fund is that inflation is going to continue to be rather robust. Not everybody shares that view, but that's what you're committed to.
Yeah, so we've had the fastest interest rate hiking cycle in the last half a century, and core PC went from like 6 to 4, and the Fed's target is 2. So we are still way above inflation kind of targets from the Fed. If you look at the 1970s, CPI stayed between 5 to 15% for an entire decade. So, like once inflation comes out of the bottle, it's really hard to put it back in, is the saying.
And what does that fund invest in typically?
So real assets, so energy, industrial, material stocks, some commodities, and then a little bit of tips. So it is a multi-asset portfolio, and it's meant to be a satellite position to kind of hedge some of the duration and technology risk that's very prevalent in 60-40 portfolios, along with nominal bond exposures, on the fixed income side.
Next, John Davi on why investors should be thinking about owning companies with real assets like industrials, energy, and materials companies.